Hi, it's Monday, May 23rd, 2016. I'm going to talk about central banks today and derivatives. Uh, in my opinion, derivatives are the main instrument that central banks and treasuries throughout the world, the major central banks, and major treasuries, it's the main instrument that's been encouraged upon banks, investors, speculators, yeah, to use in order to keep the fiat money system going. You know, a system, as Professor Fiketty says, is based on empty promises or government bonds, which are not backed by anything since 1971, when the US went off the gold standard. And prior to 1973, derivatives were based upon agricultural commodities. They were there to protect the farmers, producers, end users to price fluctuations due to, nature, weather and things like that. There was no such thing as interest rate derivatives, bond derivatives, foreign exchange derivatives, because the system, monetary system, was stable and it was based on real money or gold, which has a track record of 5,000 years. And I'm not saying that in the gold standard prices were completely stable. They did fluctuate, but you did not need derivatives to hedge your exposure to interest rates. And I quote here from an article he wrote 10 years ago, roughly, and I'll put the link below. And I quote now, Antal Fiketty says, "It was not until 1973 that the Chicago Board of Trade opened its options exchange to trade options on financial futures, marking Big Bang, the beginning of the explosive growth of the derivatives market. Notice the coincidence of Big Bang with the U.S. government's default on its international gold obligations, Nixon closing the gold window. Incidentally, the same year marked the explosion of volatility in commodity prices as well. The derivatives market grew from zero to 865 billion during the 15 years from 1972 to 1987. During the next 15 years, from 1987 to 2002, it grew to 100 trillion, or more than 100-fold. It trebles on average every 4 years. The latest report of the Bank for International Settlements states that the gross market value of amounts outstanding in the OTC derivatives market at the end of December 2005 was 285 trillion, of which the largest component, the interest rate derivatives contracts, was 215 trillion. The amazing thing is that the total value of bonds outstanding worldwide is estimated at only 45 trillion. How can you write contracts to buy bonds 5 times greater in amount than all the bonds in existence? That's what Professor Fiketty asks. Does this not give the lie to the word derivatives, meaning that these contracts derive their value from the underlying assets? What kind of musical chairs game is this? When the music stops, that will happen to those who are out of luck and hold the bag. So this was written in 2006. So, a couple of years later, he was proven right, but the system was saved. The BIS says that we've got 600 trillion in derivatives now. After the crisis in 08-09, they changed their accounting. I think they mark to model now how they count the derivatives. But at one point, they said that it was about 1.2 to 1.4 quadrillion. So I would even argue that these numbers are conservative, coming from the Bank for International Settlements. And Professor Fiketty also argues that derivatives create an artificial demand for government bonds. And I agree with them, and it creates artificial open interest It gets the speculators in, and it keeps the price of treasuries and bonds or French government bonds. It keeps them all artificial because they think it's risk-free. Especially now that we're seeing QE and forward guidance saying that rates are going to stay low. But his argument is, what if one day things turn and interest rates start going up? These speculators, investors, they're going to try to rush out, and they've bought a lot more bonds than exist. That could bring the whole system down. And the flip side of the coin he talks about is the huge short open interest in gold, which keeps the gold price in check. And he was talking about that back then already. And recently we're seeing, the commercials go shorter and shorter, the COMEX gold, which is based on the CME. So with that in mind as well, I'll switch to the CME now. They've got a program called Central Bank Incentive Program. So, and they've got a section, and I'll put the link to this below the video, and it says, second point of their section about this program, it says, how does an applicant qualify for the CBIP, Central Bank Incentive Program? To qualify for and become a participant in CBIP, the applicant must first be a non-US central bank, multilateral development bank, multilateral financial institution, sub-regional bank, aid coordination group, or an international organization of central banks. That's the key point that I wanted to point out, an international organization of central banks. And which organization is that? Well, it's the Bank for International Settlements in Basel, Switzerland, of which the Federal Reserve Bank or system is a member. And if you look at their Wikipedia page, which I'll put a link below, it says, as an organization of central banks, the BIS seeks to make monetary policy more predictable, and so on. So, yes, so this program is to help the BIS. I guess other central banks can use it, but it's very, interesting that the CME, they can't be seen to be dealing directly for the Federal Reserve, and they even say a non-US central bank, you can use that. But I'm sure they also deal for them, maybe for the U.S. Treasury through the Exchange Stabilization Fund and J.P. Morgan futures. But it looks like this was designed to help the BIS, which is an international organization of central banks. And this program is good to the end of this year. And they're giving, the central banks a pretty good discount on trading all the derivatives they have, all the exchange traded derivatives, including COMEX gold and silver. So, I'm 100% sure that there's a lot going on, not just in the metals, but in, interest rates and even in the stock market. That we don't know. I can't call the CME in Chicago and ask them, what's the BIS been doing, because they're a client. They can't divulge. It's private information. So there you go, and the other interesting about the CME is that JSNP4, he's mentioned that, the possibility of a false flag to close down that exchange, in Chicago. And, I would say you don't really need to close the exchange physically. It's more because 95% of all the trades done now on the CME are electronic. They used to be on the floor of the exchange back when I started as a futures broker in the 90s, but now it's all on the screen. So if anything, it's more of a cyber problem that could, snag things. And even though exchange traded derivatives are about less than 20% of global derivatives notional amount. If there's a problem with the exchange traded derivatives, there will be a problem, believe me, with the OTC derivatives, because a lot of the participants in the OTC derivatives, they use the exchange traded derivatives to lay off their risk, and it could be a huge problem. So in my opinion, we're only going to see this, it will be an important event if there is a problem with the derivatives market, especially the interest rate derivatives market, because that's what keeps the phony, house of cards, fiat money system going. So yeah, and that's it for this video. I hope you enjoyed it. If you like my channel, please subscribe if you haven't yet, and share it with friends, colleagues, and family. And if you like the video, again, please give me a thumbs up. Thank you. Take care.